worst GDP report since the end of World War II.
America's GDP shrank 32.9% in the second quarter of 2020. Economists say that is an unprecedented and rapid drop. GDP stands for gross domestic product, and it is the monetary value of all goods and services made in a country during a specific time. Well, joining us live to explain what the sharp drop means for our economy amid this pandemic is George Hosfield, Director and Chief Investment Officer with Ferguson Wellman Capital Management. Good morning.
Good morning, Jenny and Emily. Great to be with you and your audience.
Yeah, thanks for coming on with us. Okay, so what does this mean? Is this the bottom for the U.S. economy? And if yes, what type of recovery do we have ahead?
Right. So first of all, to give some perspective, prior to this release, the biggest drop we have ever seen in a quarterly GDP number was 10% in the first quarter of 1958. So this is dramatic, but not unexpected. Expectations were for a decline of 35%. So the good news, as you hinted, is this is the bottom. The recession is over, and the question is just how rapidly does the economy recover from here?
Yeah, we sure hope that this is the bottom and that we can continue to reopen safely so that we don't continue to see a worse effect on the U.S. economy. What kind of recovery are we potentially looking at here? I remember when all this first started happening, there was some talk of kind of a V shape. Is that at all the case?
Yeah, our attitude since March has been a check marker. Living here in the Northwest, think of a Nike swoosh. And we're at the very bottom now of that swoosh with the second quarter release here. We've hit the bottom, and now we're trajectorying up and somewhere around a positive 20% for the third quarter and probably 20% positive GDP growth for the fourth. So again, it's all going to be dependent on the COVID infection rate. But our view is that at some point, Emily, by the end of 2021 or early in 2022, that we'll have economic growth, the value of all goods and services, that is, back at a level we saw in 2019. So it's going to be a long workout.
Yeah, and certainly a much slower recovery than the decline we saw.
Oh, definitely. You know, with this data so dire, we have been, we follow the stock market. We have those numbers every day. It does seem to still be doing pretty well. Why is that the case? Why is there the contrast there?
Right. That's been the most frequently asked question probably the last month. And we understand the sort of dichotomy. The fact is the stock market is a forward-looking discounting mechanism. Think about driving your car, and economic data is the rearview mirror. It's already happened. It's a point in time, whereas equity prices and the equity market is the front windshield looking out. People that buy stocks today are buying the stocks based on what they think the companies will earn 6 months, 12 months, or more out in the future. So the economic data is going to continue to be difficult. We're not out of the woods there by any stretch, but investors are looking past this economic valley and to the ultimate recovery in late 2021 or 2022.
Yeah, I think up until this point, up until today's new numbers, we've really been focused on the unemployment numbers, and we've had those weekly and monthly unemployment claims. So where does this GDP picture fit into kind of the picture of the labor market?
Right. The job market is the human side of this economic data you see, and it's going to continue to be very, very difficult. We saw continuing claims this morning of 17 million. In other words, week after week here, we still have 17 million people unemployed. So far, only about 3 million of those are permanent job losses. The balance is deferrals. But understand, in the Great Recession, we lost permanent jobs of about 7.5 million and took about 8 years to get those jobs back. And we don't think it's going to be any different this time. So it's going to be a long, painful workout on the labor front, to be sure. But remember, the market moves ahead of the underlying economy by about 6 to 10 months. So last time the economy bottomed about 10 months after the stock market started moving ahead. So what we've seen this time is business as usual. The market's anticipating the recovery.
Okay, and so what does this all mean then for investors?
So investors need to, again, much like the market takes a long view and takes a look beyond the horizon here, investors have to do the same, to continue to focus on the long-term strategy they have in place, not make short-term sort of panic moves and stay the course, recognizing that we'll get through this and the market will recover and set new highs like it has done every time after recessions.
Is it a good time? My mom, just for the layperson, my mom likes to buy little shares of things every month. Is this a good time to be doing that?
If it's consistent with your mom's long-term plan, then yes, continuing to nibble away and stay, again, focused on the long term, she'll be rewarded for that discipline.
Okay.
There you go. Yeah,
All
no,
right.
no knee-jerk reactions, whatever you're
Right.
thinking. Always good.
Right.
George, we appreciate you helping us make sense of it all. Thank you for your insight this morning, and take care.
Our pleasure. Same to you.
Absolutely. And of course, if you want more on the second quarter GDP numbers, the new report out today, you can head to coin.com for the very latest.